Hello everybody, my name is Lush Eisner and welcome to the Canadian Money Talk, the channel about Canadian investing and personal finance. Please like and subscribe. I record a video per week, so make sure you ring the notification bell to get notified each time one comes out. In this video, I'll explore how volatility and returns are related in your investments and how you need to stomach volatility to get significant returns. I'll then show a counterpoint looking at a low volatility ETF example. So generally, risk or volatility or ups and downs of the asset are related to the returns of the asset. Ups and downs are generally accepted as the price you pay for the return. Not everyone likes the ups and downs, or perhaps needs the money back soon and cannot have the asset be on a downturn when the money has to be pulled out. So you can see the line runs from cash, which is safe without volatility, but generally makes little in return, all the way to crypto, which is super volatile, but has the possibility of high returns if you time it right. An investor's goal is to get best returns for the lowest volatility, or picking investments that, for a given return, have the least volatility. Economists call this being on the efficient frontier, which is the set of optimal portfolios that offer the highest expected return for a defined level of risk, or the lowest risk for a given level of expected returns. Which assets offer the most attractive risk-reward profile for investors, and what does the history show us? This macrobond chart compares the volatility and the compound annual growth rate, CAGR, of various asset classes over the past 20 years. CAGR represents the average annual growth rate, assuming that profits are reinvested at the end of each year. U.S. equities have been stable over the period, with only minor fluctuations in price while yielding the highest growth rates, suggesting a favorable risk-reward balance for investors. Although emerging market equities have experienced higher volatility, their returns have been relatively lower compared to their US counterparts. This indicates a higher risk associated with the returns achieved from investing in emerging market equities. Looking at the past 20 years, emerging markets should be avoided or underweight in your portfolio, although I feel demographics of emerging markets will win out in the future. On the other hand, European equities, infrastructure investments, and real estate investment trusts, REITs, have displayed a narrower range of volatility and moderate growth. Consequently, these asset classes can be considered as stable investment options, offering reasonable growth potential for investors with more conservative risk appetites. There are niche products out there based on studies that show that low volatility actually comes out ahead, contrary to the general belief. I've looked at low volatility ETFs before, so let's take a look at ZLB just as an example and as a counter to the return and volatility are related concept. I compared ZLB to XIC. XIC is an index ETF which covers roughly 95% of the Canadian equity space, but other than containing Canadian stocks, the two ETFs' composition is very different. ZLB's biggest holdings are consumer services, while XIC's biggest holding is financials. XIC has the biggest one-year return, ZLB wins over 3 years, XIC wins over 5 years, and ZLB wins over 10 years by over 2.5% per year. It'd be a good diversification, and there's nothing wrong with ZLB. Other than the general belief that you need volatility to get returns, ZLB seems fine and is skewed towards a more conservative and defensive sectors. ZLB seems to be just as good at ETF in general, although not over all time frames, and the low volatility in other ETFs seems to be a drag on performance. So ZLB is exceptional in that sense. If you have any requests on what you'd like me to cover in future videos, please put that in the comments section. If you'd like to get in touch, please reach out on any of these social media channels, and may you have a profitable day.